Hi and happy holidays. I'm Gloria Ledoux bringing you the Compliance Outlook for a review of the fourth quarter of 2016 and the first quarter of 2017 at the CU Compliance Connection by InfoSight. The biggest event in the fourth quarter of 2016 was the effective compliance date for the Military Lending Act. Although the DoD, or the Department of Defense, did issue some clarification to the initial rules that were published, I think most of us are still hoping for some additional clarification on the clarification. A surprising twist was the Department of Labor's overtime rule that was scheduled to become effective on December 1st regarding the payment of overtime to certain employees. This rule was actually blocked by a federal judge at the end of November, so credit unions are no longer required to comply with the changes until further notice from the courts. Starting off our first quarter of 2017 with a bang are the NCUA's new member business lending rules. Not to be outdone, the CFPB also has some changes for us, including one small piece of the new HMDA rules, the Home Mortgage Disclosure Act, and of course the annual updates that we have tied to the various consumer price indices. The Military Lending Act became effective on October 3rd of 2016. While the final rule was published in July of 2015, the Department of Defense also published interpretive guidance on the rule in August of 2016. As mentioned earlier, there is still further clarification needed on certain aspects of the rule. However, until that is received, credit unions are doing their best to comply with the provisions. The first critical part of implementing the Military Lending Act is to determine if the borrower is considered a covered borrower under the rules. There are two safe harbor methods for doing this, including using a credit report from a credit reporting agency or using the Department of Defense's database. Once the credit union determines that a borrower is covered and they are applying for a covered loan under the rules, they need to, number one, make sure the credit union is providing them with the mandatory loan disclosures required under the rule. Number two, that they're properly calculating the military annual percentage rate, ensuring that it does not exceed that 36%. And number three, providing them with the protections that they are entitled to under the Act. For the mandatory loan disclosures under the MLA, there is safe harbor language provided. Credit unions are encouraged to use that to guarantee their compliance with the rule. Remember, there's also a requirement to provide the disclosures orally, in addition to providing them in writing. In order to comply with this requirement, the credit union can provide a toll-free number to the covered borrower. The DoD did clarify in their interpretive guidance that credit unions can use a pre-recorded message to meet this oral requirement by providing a general description of how the payment obligation is calculated or a description of what the borrower's payment obligation would be based on an estimate of the amount the borrower may borrow. On this slide, we've highlighted the fees that the credit union is required to include in the MAPR, or the Military APR, calculation for covered borrowers. Also, for those credit unions that don't have internal systems to calculate the military APR, we know that there are calculators available through CUNA and CUNA Mutual that can assist credit unions in determining that numerical MAPR, which cannot exceed the 36%. Credit unions are prohibited from requiring covered borrowers to waive any of their legal rights, require arbitration, impose any onerous legal notice provisions, or demand any unreasonable notice for a borrower as a condition for legal action under the MLA. At the end of November, a federal judge issued a nationwide preliminary injunction that went into effect just before the December 1st effective date of the Department of Labor's new overtime rules that would have increased the minimum annual salary level for an overtime exemption to $47,476 from $23,660. This means that credit unions will not be required to pay overtime in accordance with these rules until further order from the court. So until then, credit unions should continue to follow the existing overtime regulations until we hear something further. Let's get started with what we have to look forward to in the first quarter of 2017. As we mentioned, credit unions should already be preparing for the NCUA's revisions to the MBL rules that become effective on January 1st of 2017. As we will discuss, there are significant changes to the previous rules, including the addition of several definitions. Credit unions might also find some regulatory relief since the NCUA eliminated some of the more restrictive requirements for loan-to-value ratios, obligor limits, and construction and development loan limits. There were also changes made to the experience provisions, eliminating the previous 2-year requirement. For those of you not currently risk rating your portfolio, this was also a significant change to the rules, and we'll be touching on that a little bit later. One of the biggest changes to the rules was the addition of the commercial loan definition. According to the commentary, this definition was added really in order to distinguish between the commercial lending activities in which a credit union may engage, which are subject to the safety and soundness provisions of the rule, and the statutorial defined member business loans that are subject to the aggregate cap. A commercial loan includes any loan, line of credit, letter of credit, and any interest a credit union obtains in such loans made by another lender to individuals, sole proprietorships, partnerships, corporations, or other business enterprises for commercial, industrial, agricultural, or professional purposes, but not for personal expenditures. There are some loans that are excluded from that commercial loan definition, such as loans secured by a vehicle manufactured for household use, or a loan fully secured by a 1 to 4 family residential property, regardless if the aggregate net member loan balance exceeds that $50,000. The definition of a member business loan includes a commercial loan, except for 2 loan types. One is a non-member loan or participation interest in a commercial loan made by another lender, provided the credit union acquired the loan or interest in compliance with all relevant laws and regulations. And then any loan in which a federal or state agency fully insures repayment, fully guarantees repayment, or provides an advance commitment to purchase the loan in full. The NCUA published a summary of the key changes to the final rules, which included this comparison chart. This chart is extremely helpful in wrapping your head around the changes in definitions and allows credit unions to more easily distinguish between those loans that are subject to the aggregate limit and/or just the safety and soundness provision under the rules. If credit unions aren't already, beginning on January 1st, 2017, they will be required to create a formal process to assign a credit risk rating to commercial loans at inception and review them as frequently as necessary to satisfy the credit union's risk monitoring and reporting policies, and also to ensure adequate reserves as required by GAAP. The score must be determined through an evaluation of financial performance and qualitative factors based on management, operational, market, and business environmental factors. The credit union must also make sure this credit risk rating system is addressed in their policy. The previous maximum loan-to-value limit of 80% was removed from the revised regulation. The credit union will now need to ensure they have collateral sufficient to provide adequate loan balance protection along with appropriate risk sharing with the borrower and principals. For unsecured loans, the credit union issues there must be sufficient documentation on file with the mitigating factors that sufficiently offset the relevant risk. In the final rule commentary, the NCUA indicated that they would issue guidance to examiners to outline appropriate industry methods for valuing collateral and establishing appropriate maximum LTVs for various collateral types. So true to their word, in November, NCUA Letter 16-CU-11 was issued with the updated examiner's guide for member business lending. We have included the accepted industry standards for LTV real estate guidance that were included in the guide for credit unions' reference. While the existing provisions remain of limiting the credit union's commercial lending to one borrower or group of associated borrowers to the greater of 15% of the credit union's net worth or $100,000, the new rule actually provides for the ability to exceed that limit up to 10% of the credit union's net worth. The ability to exceed this limit is contingent upon the amount exceeding that 15% being fully secured with a perfected security interest and readily marketable collateral. The new rules include a definition for readily marketable collateral. While the commentary does provide some additional background on this definition, it's important to reference the NCUA's comments that indicate that the term was designed to be comparable to existing bank regulations, referring to financial instruments that must be saleable under ordinary circumstances with reasonable promptness at a fair market value, determined by quotations based on actual transactions on an auction or similarly available daily bid and ask price market. So we know that we have some big changes coming up for the Home Mortgage Disclosure Act, or HMDA, most of which become effective in January of 2018. However, there is one aspect of the rule that does become effective on January 1st, 2017, and that is the revised definition of a financial institution. So this will be important for credit unions to consider when determining if they will be required to report HMDA data for 2017. So basically, in addition to the previous criteria, such as asset size, which is currently at 44 million, but the CFPB hasn't come out with that change yet this year, having a branch office in a metropolitan statistical area, being federally insured or regulated, the new rules actually now add an additional test for the credit union to meet. Therefore, in addition to the previous requirements that we just listed, for 2017, the credit union must also have, in each of the preceding 2 years, originated at least 25 home purchase loans, including refinancings of home purchase loans, that are not otherwise excluded. So the excluded data, which is outlined in 1003.4 Section D, includes loans originated or purchased by the credit union acting in a fiduciary capacity, loans on unapproved land, temporary refinancing, the purchase of an interest in a pool of loans, the purchase solely of the right to service loans, or loans acquired as part of a merger or acquisition. So, to put this all together, a credit union that originates at least 25 home purchase loans, including those refinances of the home purchase loans, in each of the 2 preceding calendar years and meets all the other criteria listed would be required to report HMDA data for 2017. However, if the credit union originated less than 25 home purchase loans in each of the 2 years preceding, then it would not be required to report HMDA data, even if it meets all of the other reporting criteria. Lastly, if the credit union originated 25 home purchase loans in one calendar year and then originated less than 25 in the subsequent calendar year, the credit union would still not be required to report HMDA data for 2017. All right, cruising right along, let's review some of the annual threshold changes. Remember, credit unions always need to make sure that their respective policies, procedures, and even lending platforms are up to date with these new thresholds that become effective on January 1st of 2017. The Home Ownership and Equity Protection Act, or HOEPA, governs high-cost mortgage requirements. If the credit union is originating a mortgage that is considered high cost, they will have to provide specific disclosures. There will be certain restrictions on transaction terms, certain restrictions on fees and practices. There are specific ability to repay requirements, and the member must have home ownership counseling. As with many of the CFPB's regulations, certain thresholds adjust each year in accordance with the Consumer Price Index for all urban consumers. So for HOEPA, the CFPB adjusted the points and fees thresholds to determine if a loan is considered a high-cost mortgage. So the credit union's loans with points and fees exceeding these thresholds will be considered high cost and subject to the additional restrictions. For a loan to be considered a qualified mortgage, the loan's points and fees must not exceed certain thresholds. These thresholds will also increase at the beginning of next year. The loan amount is the amount financed minus points and fees that are rolled into the loan. Again, as with all of these changes, credit unions should again make sure that their systems and applicable policies and procedures are updated to reflect these changes if they haven't already. Although I don't really think any of our credit unions are bumping up against these amounts, it's important to keep in mind these safe harbor penalty fee limits. While 2016 started off with a $37 limit for subsequent violations, when the CFPB published the 2017 thresholds, they indicated that they made an error in their 2016 calculation, and effective immediately, the limit was $38. So I suppose for the latter part of 2016, there technically was not a change in the fee for 2017. At the time of this video production, the CFPB has not yet released 2 annual threshold revisions, including the HMDA asset size exemption threshold that we mentioned earlier, and the high price mortgage loan escrow account exemption asset size threshold. We will have those updates for you in our next quarterly update. Thank you for joining me at the CU Compliance Connection, and stay tuned for future broadcasts on issues that affect your credit union. Happy holidays to you and yours, and remember, we are here to help you at the CU Compliance Connection by InfoSight.